While most people still think of gold as something slow, boring, and already done, something very different is quietly happening right now. Gold is no longer acting like a defensive asset that only wakes up during crises. It is behaving like a monetary signal. And if gold can hold strength above the $5,000 level in the coming cycle, it doesn't just mean higher prices. It changes how money itself is being valued. It changes how investors position. And it changes how silver, currencies, and even risk assets respond. This is one of those moments that looks calm on the surface, but underneath, the structure is shifting. Before we go deeper, if you follow global markets, gold, silver, and the real forces shaping money, make sure you like this video and subscribe to the channel. This is the monetary shift, and everything we do here is about helping you see these changes early, clearly, and without hype. Now let's slow this down and talk clearly about why the gold market looks different this time. Historically, gold moves in response to fear, inflation headlines, or short-term currency stress. But the current strength is not coming from panic buying or retail excitement. It's coming from long-duration capital. Central banks are still accumulating. Sovereign funds are reallocating. Long-term investors are treating gold less like a trade and more like a reserve. That distinction matters because reserve demand does not disappear quickly. It builds a floor. When markets start to accept prices near $5,000 as normal, psychology changes. Gold stops being viewed as expensive and starts being viewed as necessary. That shift alone can support higher prices without explosive moves. Strong markets don't always move fast. Sometimes they move quietly and relentlessly. At the same time, the macro backdrop is doing gold a favor. Real yields are unstable, not decisively high. Debt levels remain structurally elevated. Currency credibility is being tested, not just in developing markets, but in advanced economies as well. This environment doesn't require a crisis for gold to perform. It only requires uncertainty about long-term purchasing power. Now, here's where things get even more interesting. Gold rarely moves alone. When gold establishes strength at a higher plateau, silver begins to reprice. Not immediately, but eventually. Silver is more volatile, more industrial, and more misunderstood. But it is also more sensitive to shifts in monetary perception. When gold signals that fiat confidence is being questioned, silver often responds with leverage. That's why the gold-silver combination matters so much for this cycle. Gold leads with credibility. Silver follows with acceleration. For investors, this pairing often produces higher engagement, higher interest, and yes, higher RPM for content creators and analysts who understand how to explain it calmly and clearly. What's important is that this isn't about predicting a straight line up. Markets don't work that way. Even in strong secular trends, gold pulls back, consolidates, frustrates traders, and shakes out weak positioning. But higher lows matter more than headlines. Structure matters more than sentiment. Right now, the structure suggests acceptance. Acceptance above previous psychological ceilings is how new regimes form. Once enough capital agrees that a level is justified, the debate shifts from can it hold to what replaces it as resistance. Another key piece most people miss is how gold's strength impacts risk assets indirectly. When gold rises without panic, it doesn't scare equity markets immediately. Instead, it quietly tightens financial conditions by signaling that capital is hedging future instability. Over time, this changes how liquidity flows. It doesn't crash markets overnight, but it alters correlations. And silver, because of its industrial role, sits right at that intersection. It reacts not only to monetary demand, but also to expectations about infrastructure, energy transition, and manufacturing. When gold is strong and silver is lagging, history shows silver rarely stays quiet forever. This is why the current phase is so important. We're not watching a blow-off top. We're watching a base being built at a much higher altitude than before. Bases take time. They bore impatient traders, but they reward patient positioning. If you've made it this far, you already understand this isn't about hype targets or viral price calls. It's about recognizing when the rules quietly change. And that's exactly what we focus on here at the Monetary Shift. One more thing that deserves attention is behavior. Notice how media coverage treats gold strength right now. It's not screaming. It's not front page panic. That's usually when trends are healthiest. When everyone is calm, smart money can accumulate without competition. As this continues, watch how silver narratives evolve. At first, it will be dismissed. Then it will be questioned. Then suddenly it will be chased. That pattern has repeated across cycles, not because of emotion, but because of delayed understanding. Toward the end of this cycle, people will say the move was obvious. In real time, it never feels that way. Before we wrap up, I want to hear from you. Do you see gold's strength as a warning signal, a confirmation signal, or simply a reflection of long-term monetary reality? Drop your thoughts in the comments. Your perspective helps shape future videos, and the discussion here is one of the strongest parts of this channel. If you found this breakdown useful, share it with someone who still thinks gold is just a relic. These conversations matter more than ever, and clarity spreads faster when you're part of it. Thanks for watching, stay steady, and I'll see you in the next update.